Hello guys, welcome to the Trading Parrot. We have an incoming CPI reading that has been held due to the government shutdown, and this is how the market has closed yesterday, pretty much in the green. The report is due to come out in about 3 hours from here. Expectations are to maintain the core inflation rate month on month at 0.3, 3.1 on the year on year, and inflation rate 0.4 to 0.4, 3.1, just slightly higher than the 2.9 on the year on year inflation rate. I also noticed that there has been a small spike in the expectation of 25 basis points from 96 roughly in the past 2 days, now back into 99%. That is considered substantial, whereas on poly market, the 25 basis points is sitting only at 96 because there's also 2% chances of 50 basis points there. Together combined is a 98% on poly market and 99 on the Fed Watch tool due to the recent events. Now, let's highlight this because it's very important. We are now on the balance sheet testing once again the support and threatening to do a continuation of reducing the balance sheet into 1618. This is something that goes kind of against the narrative of the quantitative easing coming in just now. If you think about it, the balance sheet has been shrinking from 3.4 trillion into 297, and this bouncing in here, although it was the first one that goes up, and we did that for 2 consecutive weeks, we did it in a very humble way relative to all the move down. So we were not out of the woods. It was just promising to do the first shift. But now that we have a new reading today on Friday, and I'm sharing it with you because it could be testing the extension of 1. The extension of 1 broken opens the door for the 1618, which is 2.6 trillion, meaning that the balance sheet could shrink beyond the level of support of January 2023. That might extend the perception of the rest of the market that something is about to become bearish once again. Before we look into the potential effect that it could have the CPI report, let me tell you that if you want to trade general markets and you are a crypto investor, there's no better option to transfer USDT from your actual exchange straight into a broker like BT Markets that is sponsoring this video. You get 100% welcome bonus thanks to the link down in the description, and you can trade not just crypto as well in here, but also you can trade forex, indices, stocks, literally everything, commodities, which is what I'm planning to do in the bear market if we get one on crypto space. So let's have a look at what has changed in the past 24 hours that is worth our attention according to Perplexity News. CPI September released today. Definitely the September CPI expectation of 3.1% year on year versus the 2.9 in August, delayed by the shutdown, is kind of opening now the pressure pan, and we'll see how it affects the market. So far it seems that it's rallying towards the reading, but in the past 3 readings that's exactly what we did, and as soon as we get the reading, then we get some pullback. Sometimes we get a lower low, sometimes we get a higher low. We just don't know whether we are gonna repeat the past performance with another pullback, and the impact currently according to the news is a 4 out of 10, so it's expected to be a bit bearish. First macro data since the shutdown. This guides the Fed meeting next week and anti-tariff inflation link. Fed rate cut odds, 97 to 100% odds for 25 basis points. That's bullish with a 7 out of 10. Near certain easing despite data blackouts support risk assets. We'll see what CPI says. Of course, if we get a reading on the CPI that inflation has spiked too much, that's again a narrative that could influence how much we cut rates. US-China trade talks has been a back and forward. It's very difficult to say whether it's bullish or bearish because that really depends on the latest tweet from Trump. Officials meet in Malaysia ahead of Trump-Xi summit, and tariffs at 51% to US and 33% at China. Rare earth export controls escalate tensions. That's a 6 out of 10 at the moment. We also have the oil WTI Brent 61.93, Brent $66.12 US. Sanctions on Russian oils lift prices. Fresh Russia sanctions tighten supply, energy cost feed inflation. So that's why it's a neutral at the moment, because it's up 7% in the past 3 days. We are still within the area of earnings, so we're gonna get all over the place, the prices going up and down, reacting to each individual earning. Here we have Tom talking about JP Morgan traders on market reaction to CPI tomorrow. September core CPI, which is the reading we are getting late, month on month reading, probability probability and the S&P expected reaction. We got below 0.25, probability just of 5%, then we get some gains. Between 0.25 to 30, we get probability 25%, that's decently substantial, with some gains as well. If it goes too far up with a 0.35, 0.40, that's where we could get losses of 5%, 0.5 to 1 point on the S&P. Of course, that has the risk of translating as well into crypto, and above 0.4 with a low probability of 5%, similar to being below 25, then we get 1.5 to 2.25% reaction to the downside. It's a very weird situation to be right underneath the all-time high and already everybody in fear. Not extreme fear, but fear. You will expect at this point to be in extreme greed, which should increase the risk of that top to becoming the top, whereas being in fear is kind of a mixed bag. Are people now taking profits? Is the high still holding and maybe it's due for another high? At least it leads you to believe that that could be one of the options. The Magnificent 7 stocks now account for 35% of the S&P 500. That is a new all-time high in density of just 7 stupid stocks. That calls for extremely elevated risk, because literally 7 stocks are kind of holding the future of the whole world. If they collapse, even everything will collapse. There will be just a question of how much each sector is going to collapse, because some of them haven't run a lot and some of them are going to have more caution to fall. Fed's total assets as the percentage of current dollar GDP. The decline in the Fed's balance sheet has been historic and it has continued as we saw earlier. The Fed's total asset as a percentage of nominated GDP has fallen to 21.6%, the lowest since Q4 2020. This also matches the level seen in Q3 in 2013 during the Fed's third QE program. The Fed now has the lowest asset to GDP ratio among major central banks, behind the UK's, which is 25%, the Euro area's 40%, and Japan's 110%. Since 2022 peak, the ratio has fallen 14 points, marking the largest drop in record. In nominal terms, total assets have declined to 37 trillion. And this is definitely important because the Fed has implied that we could be entering quantitative easing, but by seeing another reading to the downside leads me to believe, are they really thinking and considering to enter in quantitative easing? Is it going to be just right after this new law, or are they kind of tricking us to believe that? Because obviously everybody wants to front run what the Fed wants to do with the balance sheet, because that leads the market. We have seen so many times how it does, at least with risk on assets. Breaking: Chinese state-owned majors suspend Russian oil purchases on fears over new US sanctions. This is from yesterday, but as you can see, news are constantly flipping, and also China hasn't necessarily been reacting to things from US apart from just compensating whatever is applied to them. They seem to act, in my opinion, a little bit more cocky, like we are big as well, we are big boys, we don't need approval, we don't need anybody to support us, we are growing very fast. And to be fair, that is kind of the case. Coffee jumps to a new all-time high. Assets like this, like coffee, orange juice, milk, whatever, this kind of food commodities are not expected to pump if there weren't fears in the market. So this to me looks like a reaction, and maybe pulling from gold and putting in other assets could be the case. That what's going on at the moment. This to me looks very bearish. Let me read it to you. In April, everyone told us recession was coming. Now everybody apparently doesn't see one coming. This is the recession expectations that are lowest since February 2022. That is the net percentage saying that global recession likely in the next 12 months. And the peaks of April 2020, November 2022, April 2025, that is the peak fear, which doesn't necessarily translate into the actual crash in a market. In March 2009, there was a peak of fear as well. So when you get that peak, you usually get a market bottom. My concern is that when you are at the very lows is when you are risking potentially to have a market top, because no one is apparently expecting that. This is not consistent with the fear and greed index for the S&P, which is currently showing fear. So how can it be in fear if no one is expecting a recession? Fear of what then? DXY bounded back from its 13 1-year support trend line and watching this chart closely, as a rally above 100 will be bad for risk on assets. And I'm with Ted. I've been doing that since July, and I've been calling for a bounce around these levels once we saw the RSI breaking out around July. The bonds market keeps signaling more rate cuts ahead. The 2-year US Treasury yield, one of the best gauges of where the Fed funds rate is heading according to bonds, has been trending lower all year and continues to do so. With 1 week to go until the next FOMC meeting and widely expected 25 basis points, liquidity conditions are set to stay supportive. So let's have a very quick look at the charts. I'll give you my take on what I think about what's going on at the moment. We are closing the weekly on the dollar right there at resistance. We are not producing necessarily a breakout. We'll see in the next few hours. If we go into 51, then we get a breakout that threatens to go with the dollar into 58. That is currently priced at around $100.6. So if we got that breakout, potentially next week we could see the dollar expanding even into over $100. Getting into that leg line, I already mentioned in every video, we could be seeing a rally into 105, but one step at a time as usual. With the gold after this correction, we are still in the territory of the liquidity hand confirmed on the weekly time frame. So this is not good. We could be seeing a revenge rally into the resistance of 79 after that could bring a new all-time high, but the signals are very clear. We are almost getting an engulfing red candle there. It's very close to be an engulfing one. We have here incoming the 21 weekly at 3.554. So if this plays out even after an all-time high, we could be chasing that 21 weekly for some comfort after such a heated move into all-time highs of 4.4k. The VIX has come perfectly to bounce to the 21 weekly. That means that we are still supporting another expansive way to the upside of the volatility, because we are now turning it potentially into support. If we close below that, then this will have been just that and we are done. Bounces of the 21 weekly after an initial push up are definitely threatening with another one, potentially even higher than this one. This one was led by Trump tariffs. It is closing below the neckline on the RSI there, but I still feel like this is a higher low, slightly overextended to the downside here. If you want the expansion, ideally it will have closed at 51, but we get still 1 or 2 signals calling for additional expansion. Timing, I don't know. Nasdaq closing at the very highs. We already know that there is some fear around the S&P, and it has slowed down for a few weeks in a row, putting a lower high in there. Potentially this could be hinting with a new lower low in terms of momentum there. At that point we could visit the 638 on the 21 weekly. Now let me see some liquidity clusters. We already covered a couple of days ago the gold one, so today we're going to focus on the S&P and the Nasdaq liquidity. And yes, on S&P we took all of this big level full of shorts, and maybe we're leaving for later over $700. We'll see about that, but you can tell that 681, 706 and 725 are levels that are very close to the price. Or if you really want with the S&P and the Nasdaq to go slightly higher and push again, a low hanging fruit is 682. Below the price we have some liquidity at 640. Let me focus just on the downside. $600 is very heavy, maybe 583 and then 531. Let's go with the Nasdaq, which is still due for consuming all of this up until 636. Then after that we have the pull of 664 into 677. On the lower end, liquidity starts piling in at 552 to 542. I won't be able today to cover really the stocks. I will expect that nothing has changed that much on the weekly relative to the rest. To me is very concerning to see this reduction in the balance sheet, and I'm hoping that everybody that is betting on the long on the CPI, we're gonna get a good reading as well in the next 3 hours. Otherwise we could be seeing that pullback coming in post CPI, which has been the case in the past 3 iterations. Thanks so much for watching this video. Remember to hit the like, write down a comment down below and subscribe to the channel. I'll see you in the next one. Bye bye. Hey, have a great weekend, of course.